Good evening. This is Jackie Knight. I'm the Corporate Training Director for STC. I'm glad to have you join me this evening for our webinar on investment possibilities in a self-directed IRA. Before we get started, I do want to tell you just a bit about STC. We are a retirement plan administrator, so we do not provide legal, tax, or investment advice. And we also don't represent or sell securities or investments of any kind. We're not a registered investment advisor, and we don't represent or endorse any investment opportunities that I will share in this presentation. We do recommend that you consult with your legal, tax, and investment advisors prior to making any investments. In this evening's webinar, I am going to cover some basic information about self-directed retirement accounts, the benefits and guidelines of self-directing your retirement account. I'm going to explain the account structure that we use for each of our clients' accounts, and then we're going to talk about many different types of investment possibilities that are available to you in a self-directed retirement account. I will detail STC services, and then I will open the floor for your questions. So first, to get started, I do want to define what we mean when we use the term self-directed retirement plan. And we mean that you can choose any type of asset that is permitted by law, by the rules of the IRS. So that would include non-traditional assets like real estate. You can hold real estate assets in your retirement account. Self-direction also means that you will manage your retirement plan's investments. You'll make the decisions that relate to those investments. And basically, you have control over the investments in your account. Let's just briefly look at some different types of retirement plans. You may be familiar with some of these. The first two are traditional and Roth IRAs. And these are IRAs that you can make contributions to from your earnings each year. The difference between the two is that Roth IRA contributions are post-tax, meaning you do pay taxes on the amounts that you contribute to a Roth. However, a big difference is that when you take qualified distributions from a Roth account, they are not included in your taxable income. So that means that monies that you have earned inside a Roth account potentially can be tax-free if they are taken in a qualified distribution. So that's an advantage right now, an opportunity for a tax-free earning opportunity. A SEP is a simplified employee pension plan. Some small businesses or even sole proprietors might have a SEP plan. You can make both an employer and an employee contribution into a SEP. A SIMPLE is a savings incentive match plan. Again, a little bit different contribution allowances. I've seen some sole proprietors, some partnerships use this type of a plan. And now I'm bringing out 4 different types of plans that all say former employer. So we have a 401k, which is a for-profit corporate type of plan. 403b, often used by nonprofits or charitable organizations. TSA is a tax-sheltered annuity, and a TSP is a thrift savings plan. If you formerly worked for an employer and participated in one of these types of plans, then you can move the monies out of that plan into a plan that you qualify for example, a traditional IRA. Now, if you are still employed, then you will need to go to your company, your entity's plan administrator, and find out if you are eligible to move some or all of your monies out of the plan into a plan that you could self-direct. A solo 401k, some other names, a uni 10k, 401k. This is a newer type of plan that was developed for sole proprietors in order to give them 401k benefits of a retirement plan. So you would be in business for yourself, by yourself, a sole proprietor, pardon me. You are permitted to make both employer and employee contributions in a solo 401k plan. You can have a Roth provision for the employee portion, so you do have that tax-free earning potential. You can also have a loan provision on your solo 401k plan, so you can lend yourself money for whatever purpose out of the plan, and then as long as it's repaid according to the terms with the interest, those monies can be used for anything. So, pardon me, that can provide you a potential growth opportunity in your solo 401k if you are a sole proprietor. One thing to mention about a solo 401k, if you are interested in that type of plan, you do have to have the plan set up and open by 12/31 of the year you want to begin making corporate contributions into that plan. So just something to keep in mind. Now, I do want to discuss just a bit about why you might be interested in self-directing your retirement plan. Self-direction does give you the opportunity to truly diversify into a lot of different types of assets that are not correlated to each other. Pardon me. As I mentioned, this can include non-traditional assets like real estate, mortgages and notes. I'm going to talk a little bit about that, and also private business investments. I did say that you choose and control those investments. And one added benefit is if you are interested in owning real estate in your retirement plan, you can use leverage, and your retirement plan can get a loan to purchase realty. So that gives you a little increased buying power because you can use a loan to finance the property in your retirement account. There are guidelines that must be followed in all retirement account investing, so it does apply also to self-directed retirement accounts. There are administrative requirements. Every year, an annual valuation of your retirement plan must be made, and an annual report submitted to the IRS. That's a Form 5498. Detailed books and records of all of the transactions inside your retirement plan must be maintained. And depending on what you own and where you own it, there might be state filings required, and in some rare instances, tax returns. I am going to talk about a type of opportunity, investment opportunity that could trigger taxes within your retirement account. Pretty rare, but there are a couple of types of investments that could require a tax return for your retirement plan. Now, STC is a full-service administrator for retirement plans, so we will fulfill these administrative requirements for your account with us, except for the tax return. We are not permitted to do that, but what we will do is provide you all the detailed records necessary in order for you or your tax accountant to prepare that return if that becomes necessary. Now, in addition to those administrative requirements, there are some additional things that you may not do in your retirement account, and there's some assets that you cannot own in a retirement account. One of those is life insurance contracts. Now, if you have a solo 401k plan, you can own a life insurance contract in that plan, but otherwise you may not own a life insurance contract. Also, collectibles are prohibited in a retirement account. That would be like Persian rugs, works of art of great value, stamp collections, coin collections. Those are not permitted as assets in a retirement account. And there are certain transactions that are also prohibited. The transactions that you engage in your retirement account do need to be for the exclusive benefit of the plan. So you cannot personally borrow money from your retirement plan. You also cannot pledge your plan assets to secure a personal loan. You cannot use your personal credit or guarantee to obtain a loan for your retirement plan. Now, I did just mention that you can use leverage and your retirement plan can get a loan, but you cannot personally guarantee it. It must be what's called a non-recourse loan, and that's when the lender only has recourse to the property that the loan is on itself if there is a default. So that's where the term non-recourse comes into play. That's the only kind of loan that is allowed in a retirement plan transaction. You also cannot benefit any disqualified person. So let's take a look at who disqualified persons are. And you'll see that the first person is you. You and your retirement plan are separate entities. Your retirement plan cannot do a direct transaction with you. And if you are married, that would include your spouse. So let me give you an example. Let's say that you personally own a very nice vacation rental property in Myrtle Beach. Your retirement plan cannot purchase it from you. There are other family members who are also disqualified persons to your retirement account. Ascendants, so that would be parents, grandparents, great-grandparents on up the line. Descendants, that's children, grandchildren, great-grandchildren on down the line, are all disqualified. However, lateral family members are not disqualified. So that would be brothers and sisters, aunts and uncles, nieces and nephews, cousins. None of them are disqualified persons. I apologize. I have a tickle in my throat. So, for example, if your father owned that Myrtle Beach property, your retirement account could not purchase it from him. If your daughter owned it, your retirement account could not purchase it from her. However, if your aunt owned it, your retirement account could purchase it. So kind of interesting what the rules don't permit and do permit. There are also two entities that are disqualified persons. Any company, if you are a majority shareholder, or any company if you're an officer, director, or a highly compensated employee. I often have real estate investors who are interested in self-directing and doing real estate transactions in their retirement account, and often they are running their real estate businesses through maybe an S Corp or an LLC, and they wonder if they can sell their retirement account, something that they own in their real estate LLC. And the answer is no if they are a majority shareholder or if they're an officer, a director, or highly compensated employee. So you do need to keep in mind that there are some things that you may not be able to do. We don't expect our clients to know all the ins and outs of these rules. We do help you with that. We've got a great client services department that can help you understand what you can and cannot do and help you structure your transactions properly. Now, I do want to go through the benefits of the LLC structure that I mentioned earlier that we set up for each of our clients' accounts. And we do this because it gives our clients maximum flexibility in structuring complex transactions. So if you have multiple parties to a transaction, maybe you have multiple parties and you're using leverage to purchase real estate, using the LLC structure can give you a lot of flexibility to do those kinds of transactions. Now, it is truly an LLC, but it is a very specialized LLC. It is designed to be owned by a retirement account. But as an LLC, it does give you an additional layer of asset protection. It is limited liability. One of maybe the nicest features of this is it does give you checkbook control over your retirement funds so that you can immediately move on an investment opportunity. Now, you will notice that I have checkbook control in quotes, and that is because STC does not give our clients the checkbook for their retirement account. Some companies do, we do not. The reason we don't is we want to be sure that you're engaging in a transaction that is viable and not prohibited. So what we do is we will look over your documents, make sure that they follow the rules and the regulations, and then we can same day or next business day fund your transaction. So you get a quick turnaround, but you also have experts reviewing the details of your transaction and making sure that it does comply with the regulations. I should mention that investing in a prohibited transaction can be very costly. The IRS does look into some of these things. They do audits on retirement accounts. So unless you are an expert, you might want experts reviewing your transactions. The LLC structure also simplifies asset titling. For example, if you do own real estate, you can actually go to the closing on behalf of your retirement account, and you can sign those documents. You don't have to send them to our offices and wait for someone there to sign them. So that simplifies a closing and asset titling. And using the structure also eases pooling or partnering with other funding sources, because your retirement account does not have to fully fund every investment. Your retirement account could be a partner in an investment. And I will talk about some of those possibilities when we get to our examples. But your retirement account can partner with others. Now, I'm going to put up 3: self, your spouse, and family members who I just told you your retirement account was prohibited from doing transactions with. And it is if they're direct transactions. But if this is structured properly, you can partner with your personal money, your spouse's retirement account, your father's money, your daughter's money. You can partner with them at the inception of a purchase transaction and co-own an investment. So we can help you structure that type of an investment if you're interested in it. You can also partner with colleagues. You might have other friends who are investors you want to partner with in a transaction. You can partner with LLCs. You can partner with investment syndications. And I will talk a little bit about those as well in our investment opportunities. So now that we have some preliminaries out of the way, let's talk about your choices in investment, and let me give you some examples of those types of investments. Again, you have a wide range of things that you can invest in. And the first group that I'm bringing out onto the screen are all different types of real estate investments. So you can invest in single and multifamily homes. You can invest in vacation investment property. Notice I put the word investment in there, and that's because you cannot personally use a vacation property that your retirement account owns. So it does need to be an investment property, so you want to keep that in mind. You can invest in tax liens. We'll talk a little more about what that is and how you go about doing that. You can also invest in raw land, building lots. We've had some client do that very successfully, and who that was an area of their expertise, and so they use that inside their retirement account. You can invest in commercial buildings and real estate syndications. So those would be group type of investments where you are partnering with other investors and co-owning or owning a piece of an investment. You can also purchase mortgages. You can make loans from your retirement account. You can purchase precious metals. And you can invest in businesses, private business investments, and actual operating businesses. I will talk a little bit more about each of these types of investments. And of course, you can invest in the foreign currency market, the Forex market, options, futures, and you could certainly have a portion of your self-directed retirement account in stocks, bonds, mutual funds, ETFs, CDs even. So you can hold those types of assets as well, but you can see that you have a wide range of different types of assets that you're permitted to hold in a retirement account. Now I'm going to give you some examples. Some of these are actual client investments and some are examples of things that you can do. So this was a client investment where the client did a purchase and a rehab of a property for resale. So this particular client had $500K in a self-directed retirement account. I believe she moved it from a 401K plan when she left an employer. She found a property that she purchased for $330 in her retirement account. She spent $140,000 to rehab this property. She sold that after the rehab and increased for a profit of $85,000. She was a real estate investor, and this was a transaction that she did within her retirement account. So in this one transaction, she grew that $500,000 to $585,000. and that was in less than a year's time. So again, if you have an area of investing expertise, you may be able to use that inside your retirement account. This is another client investment. This is a rental property. This woman purchased rentals for appreciation. So what she actually did is she too had $500,000, and I'm rounding these numbers a bit, in her retirement account, and she purchased 2 rental properties. So she put approximately $500,000 down, and the remainder was non-recourse loan. So she did not fully fund this investment from her retirement account. She actually got non-recourse loans on the properties, and she's now, she is now renting these for their current income stream. And then at some point down the road, she plans to sell those properties and realize that appreciation into her retirement account. So you certainly can purchase property for rental. I know some folks are interested in doing that in college towns, purchasing a home or a small apartment building or duplexes, and then renting those to college students. So that's something you might want to look into if that's of interest to you. You can also invest in foreign countries. You will want to look at the laws of those countries, but we had a client who invested in a vacation condo in Costa Rica, and another looking at a land development opportunity in Mexico. So those are possibilities. If you are familiar with realty in some other countries, you might want to consider looking into that. Now, I do want to talk a little bit about foreclosures, because I do know some folks who are real estate investors do look for these types of properties. And first, I want to define what a foreclosure is. A foreclosure occurs when the owner of the property is in default and a notice of default has been filed in the court. So they're in default, they've received a breach letter from their lender, and it has been filed and they are in default. Now, you can locate foreclosure properties by going to the state judiciary website. That's one opportunity. You can also go to the courthouse in the area that you're interested in properties and request their pending litigation of active foreclosures. And that's going to give you a list with information on how to find the properties, see how much is owed, look at other properties in the area, that kind of information. You can also search newspaper ads for auctions, and what you'll want to look for are trustee sales. And you can also go to auctioneer website. I did this a while back in the area that I used to live in, and I found a slew of properties on auctioneer websites. So I was just doing an initial search to see what might be out there, but you can find a lot of information online if you're interested in locating foreclosure properties. Now, there are some things that you do want to consider in foreclosure investing. You do want to understand if the state that you're looking at purchasing foreclosed property in, if it has foreclosure law. And if you aren't familiar with foreclosure law in that state, you may want to find a real estate attorney who is proficient in foreclosure law, because it can be complex. There might be restrictions on purchasers of foreclosed properties. You want to know what the foreclosure process is, and you also want to know if the original property owner has the right of redemption, because that could affect your foreclosure proceedings. So just some things to think about if you're interested in foreclosures, and possibly do your research and education on these kinds of ideas. Now, beyond foreclosure properties, I do want to talk about tax liens. First, what are tax liens? What you're purchasing when you purchase a tax lien is you're actually purchasing the right to collect on a delinquent taxpayer's debt. So we know that we have real estate taxes, and if a property owner is unable to pay those taxes and becomes delinquent, that taxing authority can sell a lien, a tax lien on their property. So what you're actually doing is you're paying that a taxing authority for those taxes, and then you get to collect from the debtor with interest. And they can generate very high interest rates. I've seen up to 18%, even 22% in some counties in certain states. So again, you'll want to do your research and look around for what interest rates these are generating. A couple of things that make them nice investments, usually they aren't very expensive. So if you don't have a lot of funds in your retirement account, tax liens might be a good opportunity for smaller balances. Tax liens are senior liens, so that means they must be paid before the property can be sold, and they are also foreclosable liens. So if the debtor does not pay you the taxes and interest that you're due, then based on the terms of the lien, you can foreclose on that property. So you might even your retirement account might become the owner of that property. So initially you're buying just the lien, the right to collect those taxes plus interest from the debtor. But if they aren't repaid to you, it is a foreclosable lien, and it is a senior lien. So there are two ways that you make money. The first, and probably the primary one that most people are looking at, is earning that statutory interest. Last time I checked, in Nebraska, you could earn 14% on tax liens, Arizona 16%, Florida had 18%, Connecticut had 18%. So you just need to look around where you're familiar with real estate, or just do some research and find out where you might want to do that. And then the other opportunity to make money is what I mentioned, potentially taking title to that property if the lien is not repaid. Now, for purchasing tax liens, there are a variety of bidding processes that a jurisdiction might use. Could be a lottery, could be a round robin. So there will be statutory bidding requirements, and you will need to find out what those are. The way to do that is to contact probably the county treasurer's office for the county where the property is located that the lien is on. Find out their specific process. They will probably have some very specific requirements. They will probably need proof of funds in your retirement account. They will probably need a deposit. They might need ACH type transactions, availability. So our client services department can help you meet the specific requirements in the county that you want to go to the tax lien sale in. Proof of funds, that's one that pretty much, as I understand it, everyone is going to require. So with a retirement account, so we can prepare a letter that is sent to the selling authority that you can print out or forward it on with proof of funds that you have available. We can issue a deposit check. So there are things that we can do to help you in these situations with purchasing tax liens, if that is of interest to you. Now, I was just at an event last night and talking with someone about retirement accounts, and we were talking about precious metals because he has been thinking about investing in precious metals, kind of just what's going on. He felt like maybe he should have something like this in his portfolio. Back in 1998, legislation was enacted that allows gold, silver, platinum, and palladium bullion that meets certain fineness standards as permissible retirement account assets. FTC accepts gold coin and bullion, silver coin, and certain ones. So if you are interested particularly in what we accept, I can give you that information directly. It's a pretty straightforward process to purchase precious metals. What you would do is you would find a precious metals broker or dealer that you want to work with, and you would place the order with them. You would receive an itemized invoice that you would fax or email to us, along with our form for your account that directs us to purchase this asset for your retirement account. It's a request to transfer funds form. And then what STC will do is we will pay that invoice with monies from your retirement account. We will receive the precious metals on your behalf, and they are stored in a bank safe deposit box. So you have secure safekeeping and at the same time easy access. It is a bank that is in the town of our headquarters. So we know where that is, and you can know where that is as well. So it's pretty safe, straightforward. We do not charge any additional safekeeping fees, storage fees for precious metals. So that's, you don't need to concern yourself with additional fees for us receiving and storing those metals on behalf of your retirement account. And now I want to talk about privately held business or operating businesses. I mentioned those on our list of investment opportunities. So you can fund, your retirement account can fund partial or whole ownership of a business. If it's partial, your retirement account would be earning a pro rata share of the net income, and that would flow into your retirement account. Now, you do need to keep in mind that this, the difference between ownership and operation. Your retirement account can own part of a business, but you cannot participate in the operations of those businesses because you and your retirement account, again, are disqualified persons. And so your retirement account can own, but you personally cannot participate in that business in any way, nor could your spouse or your parents or your children. All of those disqualified persons would also be disqualified here. So you do want to keep that in mind when you're considering a business investment. Now, if you are interested in investing in a privately held business, in evaluating a business, you may want to consider working with a business broker. They will have expertise in helping you evaluate the risk versus the potential reward from a particular type of business in a particular area. They will be able to help you discern what would be included in the purchase price, things like wood furniture, fixtures, equipment, inventory be included if it's that type of a business. Usually a market rate lease is included, goodwill, intangibles, but a business broker would be able to assist you in determining what would be included in the price. Now, one thing that is interesting, and I've talked with a couple people about this, they were interested in knowing if you could use leverage, if your retirement account could use leverage and seller financing. So could the seller of this business actually loan your retirement account the money to purchase the business, a part of it? And that is permissible as long as none of those disqualified person rules are violated. Again, we would recommend that you seek competent counsel on potential tax consequences. There is something called UBIT, Unrelated Business Income Tax, that the IRS has determined can be relevant in an otherwise a tax-deferred or tax-free retirement account. Unrelated business income tax, and it can relate to owning a business and receiving business profits, and it also can relate to leverage. So there could be UBIT tax consequences in your retirement account from a business investment. There could also, if you down the road sell the investment, that could also incur some taxes on from your retirement account. You do want to keep in mind, if there are taxes, it means you've earned money. So if there's no earnings, of course there can be no taxes, but you will want to talk to a tax advisor if you're interested in this type of an investment, and just understand how those might come into play in your retirement account. Now, another type of investment is a loan to a business owner. So this isn't actually where you're owning a portion of the business, but you're actually making a loan to a business owner. And that loan could be for something like startup working capital, if it's a new business. It might be to fund inventory purchases in a growth situation. And you, as the retirement account owner, can set the terms. Pardon me, I've lost here it is. Can set the terms of the loan. So the terms of that loan can be for a percentage interest in the business, or it could also be a percentage of the profits of the business. And you could set the terms, the time, the rate, all of those, the payment details, schedule of a loan to a business officer. So another opportunity to potentially own part of a business if you decided to go for the percentage interest in the of ownership as well. This is a loan that one of our clients made, an investor guaranteed loan. He had a colleague who was an investor who was looking for funds to invest. And so his retirement account made a loan. He transferred $100,000 into a self-directed retirement account with STC, and then he loaned money to this investor from his retirement account for a guaranteed return of 10%. And this was a promissory note that was written out. So again, the terms of this note are determined by you and the borrower. So you're going to be setting the terms if you're going to make a loan from your retirement account. Now, this is an example. I've had some people ask me, well, is there a way I could, have an investment and still help out a family member? And you can. So let's talk about, this is just an example. This is a loan to a cousin to purchase a home. So you remember, a cousin is not a disqualified person. They're a lateral family member. And in this case, your cousin recently divorced. Her financial stability is a little upset, and she can't qualify for a loan on her own. She needs a couple of years to get back on track. So she's found a house. The purchase price is $150,000. She does have 10% down from the sale of a prior home. You look at the neighborhood, you feel like this is a good investment, a good possibility. So you give your cousin an interest-only loan at 8% with the principal due in 2 years. And I haven't done this in my retirement account, but I have actually done this type of transaction with a family member, and it worked really well to help them out in a difficult circumstance. And they repaid the loan back to us in 3 years. So it was profitable for both of us, and we were able to help them out. And the nice thing about this is, in this example, you would earn nearly $11,000 of interest a year, and it's secured by real estate. You would, of course, want to put a lien on this transaction so that if your cousin did default, you could actually foreclose on the property. So it would be secured by the real estate. So it is possible to help a family member and still benefit your IRA if you're using funds from your retirement account. Now, this is a client investment in a loan pool. This was an example where a client IRA, from their IRA, they contributed $50,000 to a loan pool. And this was a company that then takes that money that is pooled together and lends it to professional rehabbers. And this loan pool has first position on the loan. So these properties that are being rehabbed are the security for the loan. So it is secured by property. So how this investment particularly works is the net earnings on these loans is then paid into the participants' retirement accounts quarterly. So it would be earning whatever interest rate professional rehabbers are looking for. Oftentimes it's difficult for them to find funds to fund the work that they want to do in real estate investing. So this is a potential opportunity to earn a nice interest rate that's secured again by property. This was an interesting client investment into oil and natural gas drilling. Their retirement account invested about $35,000 in a syndicated oil natural gas drilling project. So syndicated means we have a whole group of investors. And in this particular investment, they were going to do 5 drills. And if they did find oil, they would have an additional $5,000 to $10,000 investment to cap the well. And there is definitely some risk to this investment. If there is no oil or gas found, the investment funds are lost. You would receive royalties, your retirement account would receive royalties on producing wells. And in this particular investment, they did have strikes on the first 2 drills. So it did prove to be a good investment for this particular client's retirement account. So another type of a syndicated investment that you could participate in. This is another group investment that we had some clients participate in. It was a investment syndicator who purchased properties throughout the company and then set up LLCs or partnerships with small groups to invest in those properties. So most of the examples were mixed-use buildings. So they might have residential on top with retail on the bottom. And you could invest for a share of the property earnings. And then upon sale of those properties, you would receive a share of the sale proceeds. Now, I do want to, I've gone through quite a few investments pretty quickly. So hopefully I've got your investment juices stirring there. But I want to show you how our retirement plan LLC structure works, so that you could see how this might benefit you. So if you look on the upper left, you'll see current custodian. So this would be where you are holding your funds right now, and you decide that you want to open a self-directed account with FTC. Then you would complete paperwork that would direct your current custodian to transfer or roll over funds to our self-directed custodian. While that process is happening, our operations department will be setting up an LLC, a retirement plan LLC in the state of your choice. Once the funds have moved to our custodian and the LLC setup is complete, then your funds, the money, is going to move to a bank account that this LLC has access to, and the ownership interest of the LLC is going to be held by the custodian. So once all of that setup is complete, then you're ready to start investing. Now, in this example, your retirement account has invested in a tax lien. So you're earning statutory interest rate on that tax lien. And if the owner of the property doesn't repay that on time, then you can foreclose on that and potentially own a property in your retirement account. You also have invested in some precious metal. You have some gold bullion in your account, and that's held in the bank in Hagerstown, Maryland, where we're headquartered. And then you have an investment in foreclosed real estate. Now, here you see that you are not the sole owner of this property, this investment. There are 4 owners. One is your father, one is your daughter, and one is some of your personal money. So those parties would normally be disqualified persons to your retirement account. However, if this is structured properly and you are co-investors at the inception of the purchase transaction, then this is an allowable, viable transaction, and you can co-own with these other parties this investment number 3, foreclosed real estate. Now, in this example, let's just say that each of you owns 25% to make it easy. So let's say this is foreclosed real estate. Let's say you are renting it out. Let's say it's in a college town. So every month you're getting rental income from this property. Your retirement account would get 25% of the rental income. Your father would get 25%, your daughter would get 25%, and you personally would get 25%. Also keep in mind that if you co-own an investment like this, if there are related expenses, those expenses are also shared pro rata. So let's say this foreclosed real estate, this property needs a new roof that costs $3,000. Then each of these 4 owners would need to pay 25% of that $3,000. You earn the money in your pro rata share and you pay the expenses in your pro rata share. And we can help you understand how all of those logistics would work if you are interested in that type of an investment. So I do want to just talk a little bit about STC. We are a full service administrator. This is all we do, is administer self-directed retirement accounts. So our approach is we set up that LLC structure that I mentioned. We offer you that protected checkbook control so you can move quickly on an investment, but you also have our experts looking over the details to make sure that it's in compliance with all the rules and regulations. We have CPAs and attorneys to answer technical questions that might come up on complex transactions. We offer unlimited guidance on transaction compliance. We have a wonderful client service department that can help you understand how to structure a transaction, how to make sure assets are titled properly, all those types of things. We handle all of that administrative back office support that I listed for you. We will maintain detailed LLC financial statements for your account. So if you have multiple assets, you'll see all of those listed. You'll see all of the income coming in, any expenses going out. All of that will be maintained in detail for you and your accountants if they want to look at that. We supervise the regulatory reporting that is required, and we oversee that annual valuation that is required by the IRS. So our goal is to provide you with all of the service, the full service that you need so that you can focus on finding the investments that are best for you. So that's your job. You find the investments, and then we'll help you with all of the transaction details and record keeping and any guidance you might need on how to structure a transaction properly. So that will be our help to you. So now I'd just like to know, how we might serve you. You may know that you want to open a self-directed account, and we can help you with that. You may have clients or colleagues who would also be interested in self-direction, or you may simply need more information. It can be a complex topic if it's new to you. So I would invite you to check out our website at stcira.com. Our corporate office number is there for you, and my direct email is there for you as well. So if questions come to mind after we have ended this webinar, you can certainly get in touch with me or our corporate office, and we can help you get those questions answered. I would also invite you to check out the website because there is a lot of information there about transactions, things that you can do, but there's also a lot of information from some of our clients on types of investments that they've done and how those have worked for them. So that might give you some ideas as well. Now I am going to take a moment and just open up the question box, and because now we are ready for questions and answers. I did get some questions in advance as well, so I will pull those out while I open these up. Okay, so again, if you do have a question, please go ahead and type that in the question box, and I will get to that as soon as I can. Okay, if I want to purchase a bank-owned house, okay, so this means the bank has foreclosed on the property and now they have taken it back. They often require verification funds. How would I verify funds that are in my self-directed IRA? You would get in touch with our client services department and tell them that you need a verification fund letter, and we can prepare that for you, verifying what funds you have available to the full amount of your account. It doesn't have to be the full amount of your account, in case you are maybe bidding on a property and you don't want them to know how much money you have. You might set a limit, but we can date that letter that you have these funds as of this date. So we can provide that for you. Do I have to have earned income in order to contribute to my IRA? Does money earned from rental income qualify? The first question is yes, you do have to have earned income in order to make a contribution, and rental income would not qualify because that's considered passive income. So the types of income that can be considered in making a contribution, an annual contribution, are wages, salaries, tips, other taxable employee pay. You can also, strike benefits, union strike benefits can be considered, long-term disability benefits. Now, if you are self-employed, net earnings from self-employment, if you own or operate a business or a farm, if you're a minister or a member of a religious order, there are some special rules, but that might be possible. So there are things that aren't earned income would be like interest and dividends, retirement income, Social Security, unemployment benefits, alimony, child support. Those are not earned income, so you can't make contributions based on those amounts. Okay. Can a self-directed IRA purchase futures, contracts, and options? Yes, it should be able to. If so, how do you open a brokerage account? You would find a brokerage firm. You would open a business account with them in the name of your IRA LLC, and then our client services department can assist you with that. We would want to see statements from that account. And you could also open a regular brokerage account, stocks, bonds, mutual funds as part of your self-directed retirement account too. Does need to be a business account, and the monies into and out of that account must flow through your retirement account. You can't put money directly in it personally or take money directly out of it personally. But yes, you can do that in your self-directed account. Can I provide startup capital for a new business, such as a retail clothing operation or an auto repair shop? Yes, you should be able to do that. Again, you want to keep in mind you can't have any disqualified persons or companies, entities involved. So it couldn't be, your daughter. Certainly, this would be a business investment. Again, you will want to probably talk with a tax advisor about the possibility of UBIT, unrelated business income tax, the possibility that would be triggered. But yes, that should be a viable potential investment. Are in-laws prohibited to loan money to? STC, we would say yes. We do, your spouse is, and we consider your spouse's in-laws equivalent. So we would say yes, just like you couldn't loan money to your father, you couldn't loan money to your spouse's father. If you're with STC, yes, we would say that would be a prohibited transaction. Okay, let me look at the time. I've got time for a couple more questions. Can you purchase additional interest in a property you are already invested in? Now, I'm going to assume that the you is you are personally invested in. And if that is the case, the answer is no. because then again, you personally can't do a direct transaction with your retirement account. Now, if your retirement account is invested in a property, maybe it's co-owned. You co-own an apartment building with other owners who are not disqualified persons, and you have the opportunity. Your retirement account has the opportunity to invest more money in that apartment building. That is certainly a possibility, as long as there aren't any disqualified persons involved. IRG, okay. This person is asking about rolling over funds. Okay. I'm going to do a little definition here because I've had this question before. When you want to move monies from a current custodian, say to us, to our custodian, you can do that with a transfer of money. So the money would go directly from your current custodian to our custodian. That would be considered a transfer. A rollover is a different transaction. A rollover is when your custodian issues a check payable to you from your retirement funds. A rollover, you have 60 days to get that money back into a qualified retirement account in order to avoid it being a taxable distribution. That's a rollover. Now, in recent years, the IRS has limited rollovers. Used to be you could do like a 60-day rollover from each of your accounts because you could have multiple accounts. Now you can do one rollover per year from all of your accounts in aggregate. So at one time you can do the 60-day rollover, but again, you've got to get that money back into a qualified retirement account in order for it not to be a taxable distribution. Well, my time is up this evening. I really appreciate you joining me. Thank you so much. I hope if you have questions, you will give us a call, get in touch with me, and do check out our website. We do educational webinars once a month, so I hope you'll join me next month. You can register for those on our website, so we would be happy to have you join us, and we would love to work with you if we can help you. Thank you. Good night.